Welcome, everybody, to the Tuesday edition of the Not Your Average Investor Show. Today, we are going over the day's headlines in our latest edition of Not Your Average Insights. And you may or may not have heard it, but there was a bombshell legislation that just happened. NAR had a big ruling against it that is going to have major ripples in the world of real estate. We're going to go over that. We're going to talk about interest rates, where they are right now, and whether investors should be buying down rates. And if we got enough time, we're going to dive into an article by the Wall Street Journal saying that boomers may or may not flood the housing market. I am excited today. I'm your host, Pablo Gonzalez. With me, as always, the man I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. That makes two of us who are fired up to be here, Pablo. It's going to be an awesome show.
Yeah, super pumped. We are having technical difficulties, so we're not live on YouTube, and that means that you, community, you are getting the only first live look in this. And you know what? I think that you deserve it. But that being said, if you haven't checked out our YouTube channel, go to YouTube, look up Not Your Average Investor Show, or go to JWB. You find all of our back catalog in there. You find our latest shows immediately live. Then they get reformatted. And on top of that, we're going through extra effort to go in there, cut out the golden nuggets that we like to call from each different episode. If you want to get just kind of like the cliff notes of the most important points of all the Not Your Average Investor Show episodes, the golden nuggets playlist in there are awesome and have really provocative thumbnails with Gregg's picture on there. Have you seen the thumbnails lately, Gregg?
I have. You are taking some creative leaps over there, I've seen.
What do you mean?
Yep.
You're the one making the provocateur gestures that we're putting on there. We're not making anything up there, but
right.
helping people find the good stuff, my man.
Yes, indeed. All right. What do we got here, baby?
Well, right now, you know what time it is.
I believe I know what time it is. It's
time for
roll
the
call.
Roll call, baby. All right,
Let's
we got John Henning, our leadoff hitter, normally leading us off in here. We got Denny Davis checking in from Razorback Country with a Merry Christmas. We got the MVP checking in. You know who that is, GC?
Mr. Lee Bishop.
Everybody knows the MVP. We got Chris Gonzaga from Fernandina. Chris Gonzaga.
Yeah, from the illustrious Hudson Valley.
From the illustrious. We haven't said the word illustrious on the podcast in a couple of shows. Happy to have him. We got the Patriot Santorios from Northern Virginia. Michael Santorios checking in. Chris Lee from Fernandina Beach. Chris Lee, I almost confused you with Chris Gonzaga for a second there, just because a lot of Christophers in the house, but we love to have you here, Chris Lee. John Moran is back from Port St. Lucie. We got the early bird in the house.
Dean Curry.
We got the shaman in the house.
Nadine Shaw.
We got Matthew Edwards, also from Virginia Beach. We got the ringmaster in the house.
Drew Barnhill.
We got our regulars, Rosalind and Gary Riley from Marietta, California. We regard you. We got the Tin Man.
Billy Green from the chilly mountains of Colorado.
Mildly chilly mountains of Colorado. Good to see. Kimberly Temple from Virginia Beach. That's a new name.
New name. Welcome to the party, Kimberly.
Good to have you in the house. Thanks, Kim. Welcome. Make yourself comfortable. We got Margaret Smith in the house, who is the, we got to make up a name for Margaret with how hard she's come in here with such great questions lately from Sarasota saying, let's go. Love that, Margaret. We got Cody Adams in the house, everybody. Cody is our community manager. We call her the mama bear of the community. If you need anything, Cody in the chat is the person to interact with. She can connect the dots for you, answer questions, send you all content, stuff like that. So everybody check in with Cody when you get a chance. We got Marie Rockoff checking in from Arizona. Good to have you back, Marie. Hadn't seen you in a minute. Jeff Pettyjohn, sunny day in Northwest Missouri. Jeff, that's a new name.
I don't know if that's a new name to the show. I feel like Jeff's been here, but you know what? Regardless, Jeff, it's really nice to have you on the show today.
Good to have you here. We got Lita Sung, beautiful investor from Minnesota. Good to have you back, Lita. We got who else we got in here checking in on the roll call? All right. We got to scroll all the way down to find the patriarch and the matriarch of the Not Your Average Investor Show community, the first family. Ken and Carolyn Moline. Ooh, we salute you. Who else we got in here? All right. I think I'm gonna go. Oh, Connie Stamos checking in from Altadena, California. Connie, I'm out in California today myself. I'm not sure where Altadena is. I am in Pacific Palisades, a nice little area over here between Malibu and Santa Monica, ahead of a speech I'm giving. All right, GC. this is a juicy one, man. Right? This NAR lawsuit, big headline, essentially big antitrust lawsuit against the National Associations of Realtors, who happens to be one of the country's largest trade organizations. Recently read a headline that they are the number one lobbyist in America. I don't know if you've
Really?
known that. Yeah, but like literally just listen to a podcast about the top 10 lobbyists. NAR number one.
Not
Spending
NRA, NAR.
NAR.
Interesting. All right.
Correct. Yeah. That's what everybody thought. Yeah, NAR. And essentially it is challenging the idea that the NAR and a couple of other big groups have been colluding in antitrust to require this fee structure that we've all become very accustomed to, the 6% seller buyer fees in a real estate transaction that creates the buyer to sell to pay 3% and the seller to pay 3% to their respective real estate agents. And this has been told by the media sources. It's going to have a big drastic could have big ramifications in all basically sales of real estate, in the sense that, a couple of good things: may help home price affordability, is going to create greater pricing transparency, and all this type of stuff. But as we know, when these big things happen, a lot of externalities come about, man. So before I go too much further in there, I got a giant document of your research on this, and I'm not a great reader. So what I want to know is, GC, what are you thinking about when it comes to this? What is not your average insight?
Well, this is a big deal. This is a big deal for the real estate landscape, for all buyers and sellers. 90% of transactions in the United States involve a real estate agent, a realtor. So, you're talking about changes that fundamentally can and probably will change the landscape for how we all buy and sell houses. And it's a big deal because of the National Association of Realtors being involved, between some of the major brokerages that are involved. The dollar amount of the lawsuit, $1.8 billion, was the damages that were awarded by, I believe, a Missouri judge on it. But there's a long way to go in this as well. The National Association of Realtors has, vowed to appeal it. You can just imagine the litigation that is going to be ongoing. So I think there are still a tremendous amount of questions as to how this plays out. But at the end of the day, it's going to change the landscape. It's going to lead to greater transparency on what people are actually paying for when it comes to both buying and selling a house, specifically when they're buying a house. And for those who have bought your own home or have invested in rental properties, some of the feedback that is always out there is that, buying a home is probably the most important or one of the biggest decisions that somebody will do in their life financially. But you tend to know the least about it. The transparency of where your money goes when it goes to closing costs and commissions paid and things like that has been a challenge for the real estate space for many years. So this landmark case will change that up. It's already leading to more transparency. And, it's been needed. It's been needed in real estate. And I think overall the marketplace is going to benefit from it. Transparency and more goal alignment with how incentives are laid out and commissions are earned is a good thing overall for the marketplace. And that's why you're starting to see these actions start to come to fruition.
Let's break a little bit of this down, GC. I want to get into it from my own prism of what I see. But before that, I want to dive into a couple of things that you said. Alignment of incentives. How do you see this being a better alignment of incentives?
Well, if you are going to spend money on something that's super expensive in the grand scheme of what you spend money on in your lifetime, a home certainly fits that bill. And if you want to have an alignment of incentives, you would want to make sure that you are a part of the decision of what that person who is helping you with this transaction earned, so that they could be incentivized to create a better experience for you, whether that is getting a better deal for you or an overall better experience of being a client of theirs. And so you would want to have a part in setting what that rate is. And when it comes to how the traditional way of real estate goes in the United States right now, those things really don't come into play on the buying side of real estate. So, and a lot of this has been the way that the National Association of Realtors has standardized it. It's called splitting. I don't know what the term is, but basically when you sell your house, you sign an agreement with a listing agent and you agree on a commission that is paid not just to that listing agent, but that is also shared with the buying agent side. And so it's predetermined. It's a listing agreement that predetermines what that seller agent is going to make and also what the buying agent is going to make, even though the home doesn't even have a potential buyer, or much less that potential buyer has never even talked with said potential buying agent at this point. So you can start to see where there's a lack of transparency and a misalignment of goals when the seller's agent basically determines what the buyer's agent is going to make. And in theory, the buyer's agent and the seller's agent should be on opposite sides of the table of the transaction. So for the normal way that real estate has been conducted for, call it, the last 100 years, when you go to buy a home, if you take on a buyer's agent and get representation as a buyer, you didn't set the rate for the buyer's agent. You're told that you don't even pay for the buyer's agent, but in reality, the seller's net proceeds are reduced and that buyer's agent actually does get paid. You just didn't have a hand in it. And then, over time, right, the incentive for a buyer's agent to become the best of the best of the best is certainly diluted by this overall, this structure. You want anytime you're making a big financial decision and you're hiring some help and some representation, you want to know what you're paying them and you want to be able to hold them accountable to that payment and that experience over time. And that's just been lacking in the overall real estate space.
Yeah, it's interesting, man. I know we talk a lot about the importance of aligning incentives in order to create great results, right? Like JWB as a vertically integrated company, that is essentially one of your biggest, I don't know, differentiators, North Stars. I guess it's not, I don't know if there's a core value that's about aligning incentives, but you've definitely built a business model based on aligned incentives by vertically integrating and seeing what the benefits are of that. This idea that the person that sells you the house is the same person that's going to manage it. And it's also the same person that created the improvements to the house. So there's no finger pointing down the line in this long-term relationship, and your business model being, hey, we make money when we sell you homes. And in order to do that, we expect you not just to invest in one, but have such a good experience. So you're going to continue to invest in more homes. I remember the first time that I realized of this kind of like break in alignments of incentives when it came to realtor fees, and the buyer seller dynamic is essentially kind of like the big thing that we're talking about here. It was a book called Freakonomics. I don't know if you ever read that book, right? Like it was kind of like, yeah, sounds like
I started to. I didn't finish it, but I do love that. I love the beginning of that book.
Great book about kind of how people behave irrationally, right? Like we think that everybody, it's all behavioral economics and stuff like that. And I remember reading it, and it hit me at a particular point in my life because it talked about that as, if you have a realtor that is motivated to sell you a property because they make money on that commission, and you have a realtor on the other side that is motivated to have you buy the property, and one could be representing both people, then that realtor is more than anything motivated to get the transaction done, not necessarily like how you benefit. Right. And I remember doing that when I bought my condo, when I first moved out to California in like 2004. I remember knowing that. I remember that the person's realtor like had offered me this like high price, and we said something lower, and she got on the phone with me kind of like barking this idea of like, man, you're not going to get a better deal than this because it's, like 2006 and things are happening and this buyer has this thing. And I remember thinking like, oh man, this person actually wants to get the deal done. So I got her to come up like an extra $3,000, and it was I was selling and it was the buyer's agent. And I remember thinking like, I got the best of this thing because I knew that incentivization. So I guess what you're saying is, if this thing plays out and this thing is decreed, like the appeals hold up and stuff, how is that like lack of incentivization going to get decoupled? Is there anything in this about that, or is that just something that you are seeing as what's driving it?
I think it is going to be decoupled to a large degree. It's already starting to be there's already started changes that are starting to happen. So the first thing is that buyers are going to have a better opportunity to decide what the buyer's agent commission will be. And there's going to be more transparency around that. I was talking with one of my friends who owns a brokerage here in town just before the show, and he was letting me know that his brokerage and many of the large brokerages, especially some who have been involved in some of these lawsuits, are now recommending an entire kind of gamut of documents to make sure that the transparency is there on the buyer's side of the representation. And so in the past, as I was sharing before, it was more of a deal that was negotiated before the buyer ever showed up. Now, when you want to go and buy a home and you engage the services of a buyer's agent, you're going to have that opportunity to understand how much they are going to make. And I don't know exactly how that all plays out. Again, this lawsuit is very new and there's a lot more to come down the pike, but more transparency, more buyer's agents having an opportunity to set the rate that their agent is going to earn is definitely starting to happen now. For those who are buying homes, you'll start to see this if you haven't already seen it. And I think it's only going to get more and more prevalent later on. And let's talk about this as being a positive. This is not just a negative if you are a buyer's agent, right? This can be a very positive thing for the best agents out there, whether you're on the buyer side or the seller side. The goal of this, of course, is to create a better marketplace. And, if you're an agent right there and you're the best of the best, but you're going to make the same as some other agent out there who's just riding the coattails of whatever the listing agent put out there, you're getting paid the same right now. It's an opportunity for the best of the best to get paid to the level that they should get paid based on the value that they create for their consumer. And, that's the way that most successful businesses operate. JWB, we want to get paid more and more and more by you buying houses from us after you have been super wowed by your client experience and your returns. And we love that. We can all win together. So this lawsuit, while on the face of it, looks to be something where, especially buyers agents might be concerned here. I tend to take an opposite view. Those who are the best of the best at being buyers agents will have a clear way to separate themselves from everybody else. And, over time, if you can be the best of the best, you can be one of the better agents out there, your earning potential should even get better because you will no longer be lumped in and earning the same as everybody else.
Yeah. I love how you're putting this as an opportunity, right? Like for me, what I see in this lawsuit is massive change in context. As long as any of us can remember, we have just assumed that this is how a real estate transaction goes, because that's just what it is. And if this thing really comes through, what it's going to do is change the context, right? Like now we have an opportunity to really rethink what is the best thing for a buyer, for a seller when it comes to a real estate transaction and working with an agent. And what I think is that whenever there are these massive changes in context, a big change in context is going to create a missing problem that gets to be filled in, right? Like when something changes, now that like gap, there's that provides the opportunity for somebody to differentiate themselves around how they solve that problem. And I think it can go a couple of different ways based on what you're saying. If you are the best of the best in this industry, you have an opportunity to position yourself as a value add buyer's agent that is worth more than 3%, right? Like you can demand more if you can show that, or provide a different kind of like pricing structure of how you create it, or completely on the other side, somebody who's out there with their real kind of like thinking caps on and really thinking innovatively, they have the opportunity to like disrupt this whole thing, right? Like one of the big changes in context is the fact that as it has all stayed, when this was ideated, the MLS was the only place that you could go to find, real estate data and all these different things. And that's just no longer the truth, right? Like now with the internet and all these things are happening, right? So the idea of a bunch of different business models coming up from this to solve the problem differently, be it what is, what is the creme de la creme and what is the, hey, you don't even need a realtor anymore, man. Like now you have all this kind of stuff and you can save all these fees, and the self-serve way, when you're talking about creating all these new documents, right? Like who is the legal Zoom for real estate transactions now, right? If the realtor doesn't necessarily have to control it, right? Like all these different things, which make me think that, which makes me think all this exists, and it is equally an opportunity for the average realtor that's out there that's already in the space. It's an opportunity for the outsider that has always like thought that this thing could be different. And it's also creates a new opportunity for the technology platforms that kind of have a head start, or developers.
I love that mindset, right? Disruption is coming to the real estate space. It hasn't really been disrupted from a typical real estate agent relationship, for 100 years. And especially over the last 20 years, if you think, there aren't many businesses and many industries out there that haven't really been disrupted with the age of the internet and everything else and the technology boom, right? Real estate agents still have been earning 5 to 6% commissions up until, now you still are, but now there's going to be a spotlight shown on it. And disruption, I think, is the key term here. I don't want to paint too rosy of a picture, though, overall for real estate commissions. What the courts signaled here and ruled here is that the National Association of Realtors and several large brokerages conspired to, inflate real estate commissions. So there's a basic general assumption that real estate commissions were too high because of these practices. That's what the courts ruled. And then overall, if you're looking at the price of homes today, and we know how much home values have gone up over time, especially the last few years, and continue to earn 5 to 6% commissions on top of those, you're paying a lot more for the services of a real estate agent today by buying an average home than you were, even 3 years ago. So, let's take the other approach of this, which is, listen, overall, because of this lawsuit and because of this landmark case, real estate commissions are going to be harder to earn for real estate agents than they were in the past, because they probably needed some disruption. Now, with that being said, you're going to have to look, as a real estate agent, I think you're going to have to look beyond a lot more than what you did in the past to kind of echo the point you just made. And you got to look outside of the traditional way things have always been done. When I think about our decision to start JWB 18 years ago, nobody did the vertically integrated approach 18 years ago. We had to spend years and years and years educating people on this model, and we still do. It's a little bit easier to educate on the model today than it was, 15, 18 years ago. But, we were one of the only ones in the country at that time to package services around giving access to single family residential rental properties and putting the suite of services around it. But like very, very easily back in the day, we could have said, hey, listen, we'll just be traditional real estate agents and we'll go and we'll operate that way. But we stepped outside of the traditional way to do things. We saw a big opportunity to highlight this asset class. And we said, wow, we could package everything under one roof to create a great experience. And that's why we make more than a traditional real estate agency makes 18 years later. It's because we built a model around that. And so I think you can draw similarities for real estate agents today. And whether that's using technology, using access to information that is there without the multiple listing service, doing things to create a better experience for your buyer or your seller on the other side. Wow, what a great time to rethink this business model and how you create value for the client on the back end. And when you do that, and when you're an early adopter, you kind of set your own rates, you kind of set your own value. And so when something like this changes the game, that's the approach that I take. And I think those who take that approach will wind up much better for this later on, even though everybody in the real estate world, especially real estate agents, is dealing with some uncertainty now. And that'll be here for some period of time as this works its way through the courts.
That's really great perspective, man. I never really kind of like drew the parallels of the fact that you guys kind of did this, and you're kind of like a real estate brokerage and in your own right, that's just doing it differently and branded differently and deliver it completely differently, right? Like you get paid for different things. Your value add is in the find the property, make it better, fill it with a tenant, have it cash flow, and then you sell it and you make your own spread. It's not just like a commission. And therefore everybody can kind of think of, how do I change my business model? To that regard, Pedro Santori to the community has a question in here that says, Gregg, generally buyer agents spend more time working, showing properties, negotiating, coordinating, qualifying, etc. Do you think buyer agents will move to a pay for service or an hourly rate? Do you think like this is a different business model? What do you think of like the likelihood of something like that happening?
No, that's not my first thought. I think what will happen is the best of the best will continue to earn high commissions. They'll demonstrate their value and people will be excited to pay for their services. Those who are not committed to becoming the best of the best will probably find another way to earn an income and they'll probably move out of the space. I think there's such a tremendous value as being a buyer's who's truly a wonderful buyer's agent. There's such a value you create for that buyer beyond just making sure somebody feels comfortable as going through the transaction, beyond just the negotiating, beyond the paperwork, right? You have an opportunity for the biggest financial decision for somebody to find an asset that is significantly undervalued or is just absolutely perfect for that family. And you probably are somebody who knows absolutely every rock, stone, pebble in that neighborhood that a year in advance of when this family potentially is going to move out. And because of your relationship and your commitment to your craft, you're going to be able to create that opportunity for that family down the line. We can come up with any number of ways to drive value, but I think what will happen here is you'll kind of see a separation there for the majority of agents. At least that's the exciting way to go about it. If I'm a buyer's agent right now, you spend a lot of time driving people around already and part of the reason I think you like being a real estate agent is you really don't like trading your time, your dollars for hours, So I think my thought would be the cream's gonna rise, right? Those who can demonstrate the most value are going to continue to earn high commissions or higher commissions than others would. And I think you're going to see a max exodus of those who just probably are not built for this craft.
Yeah, man. I like that take, man. I also have to say that in a world where things are changing, there will be the opportunity to create the Spirit Airlines of the real estate world, right? So to Michael Santoros' point, if you can figure out how to brand yourself as hey, we don't charge commissions, we just charge an hourly rate of like us having to show you around, and we specialize on buyers that already feel like they know everything and really just need somebody that like knows how to work a lockbox, and like somebody will win the commoditized low price war here as well. So that is an option to build a big business around. That's not really going to benefit the individual realtor, right? Like you're essentially going to be hiring a bunch of like per hour employees and figuring out how to systematize that and market to that and find that buyer, right? So that is definitely one opportunity that's gonna come out of this. I think the better opportunity, if you're thinking like a realtor, right? Like there's two ways of thinking about it. You're thinking like a realtor, right? Which is like how you brand yourself around the problem that you solve and drive the most value based on the transaction and not trade time for money. And then there's going to be the business builder kind of mentality that thinks, how can I operationalize something and create labor leverage as opposed to knowledge leverage, which is what a realtor cuts their teeth on. I personally, if I was a realtor, I'd be thinking of, okay, so there's one thing that I can do, which is specialize in these residential homes. I think, if we bring it to the topic of the show, the opportunity of being the investor realtor, right? Like the person that like knows how to talk investor and knows how to bring people investor deals, not just residential deals as well. That's probably one way to diversify from only having to count on 3% commission fees that may or may not be going away. And I think that's another good opportunity to talk about this kind of like ecosystem that JWB has with realtors and people that are trying to invest in Jacksonville that I don't think we talk a lot about on the show, GC.
Yeah, 100%. I mean, I think it's an opportunity that I'd love to explore more and more, especially with those who are here on the show in the community, and for those who, are local and even who are not local, as far as real estate agents that, want to partner up with JWB. I mean, as a part of kind of who we are and how we, continue to thrive as a business, it's about our repeat business and our referrals. And, our referrals come from licensed real estate agents. the vast majority of them do, and that's how they can earn a commission. And so if you think about overall that this is going to put downward pressure on commission prices because, that's what this type of disruption and transparency will do. So overall commissions probably are going to come down for real estate agents, and you got to make up that gap. One of the ways that you can provide value for your buyers is to work with a vertically integrated company who's been there for 18 years, who's, managing hundreds of millions of dollars of assets and has performed quite well. You can make that connection and you can continue to earn that type of, commission structure. So that's what our agents do. That's what our referral relationships do. They are able to partner up with JWB. We're able to take a lot of the heavy lifting of the analysis of how to invest in real estate. And our team's able to facilitate that, keep that real estate agent in the loop the entire time. And then ultimately that real estate agent is able to earn a sizable commission, not just on that one transaction, but for every transaction in the life of that client with JWB. So another form of passive income. And it certainly is needed as you start to think about the overall commission landscape being more challenged for real estate agents.
Yeah. So to Gregg's point, if you're a realtor and you want to start also helping investors that want to invest in Jacksonville, not just people that want to live here, and you want to have a inventory that you can show them and a partner that is going to deliver. I know that Cassandra is in the chat right now. She kind of manages that program for JWB, so you can reach out to her directly, or you go to chatwithjwb.com, have that conversation of how you can add that to your mix as well, right? Like what Gregg is talking about, you now get to plug into this idea that if you bring JWB an investor, most people that purchase with JWB will go on to buy 3, 4, 5, 10, 20 properties. And then it becomes mailbox money at that point, which is another way to monetize, right? Like this branding yourself around that thing. The last thing that I will say is, if you're going to stay the realtor route, I think a real understanding on how to market yourself around a niche or a real level of expertise that you are going to have, be it you are the downtown realtor or you are the realtor that's that's specific to people with young kids that are Christian or whatever, right? Like this idea of having to niche down in order to be seen as less of a commodity and more of a trusted expert, I think is definitely something that's going to become more and more important for you as well.
Yeah, I think that's what happens when disruption comes your way. It forces folks to think differently, and those who do, usually a combination of kind of niching into the real value that you can create, making it painfully obvious for the person on the other end that you are speaking their language, that you are there to help specifically them. So I think that's where you're going with that. And I think that's going to happen. And then I think, when everybody understands exactly how much a real estate agent makes, it's going to force that real estate agent to think of additional services to provide. Because let's face it, buying real estate is complicated. It is clunky. It could certainly use some better thoughts, ideas, practices to make this an enjoyable experience as a standard real estate transaction goes. And I think realtors will be, presented with the opportunity to help fill that gap because the commissions are not going to come as easily based on this lawsuit.
Got it. All right. Good stuff, GC. We got a question here from the MVP, Lee Bishop. He says, I know that all this documentation is in the HUD and it can be over 100 pages. The rates are already listed in the HUD closing papers. Does this mean that the rate is going to be explicitly explained in that documentation to make it even longer?
Who knows? Who knows where this all actually lands as far as what documentation and paperwork is required. I think it's a fair guess to say that, yes, it's going to become longer, which creates more of a reason that you need an expert to help you, decipher it. So, yeah, I think more documentation is coming, longer documentation. I think that's happening. It's already starting to happen. And so I just saw Dan in the chat there. Dan McCarthy is a good friend of mine and somebody I was just talking to right before. And he was letting me know that now there's very strong recommendations that are given to many brokerages out there now to disclose the buyer's side representation. And that just wasn't done prior to this lawsuit. It was never required. But now there's very strong recommendations that are being given from many brokerages out there. I think it will become the norm and the standard eventually, especially as this goes through the courts. And some other interesting facts. I just, as we're kind of buttoning this thing up, I was starting to think about, how do other countries what are their relationships with real estate agents? Yeah. And so, and I didn't really know this before, but in the United Kingdom, there's typically not buyers agents. I'm pretty sure in my conversation with my sister who lives in Australia, she was telling me the same thing, that there's no buyers agents in many other parts of the world when they go to buy real property. And then specifically in the United Kingdom, I looked it up, and typical real estate commissions are 1% to 2% of the purchase price. Now, for many parts of the UK, purchase prices are much higher than they are in the States as well. So still very well compensated, but you're starting to see just overall, you start to look at those other data points of how people are doing it outside of the United States, where the National Association of Realtors and the standards and practices that have been in place for 100 years are being done. You can start to see some big opportunity for an overall improved marketplace and better experience for those who are buying and selling.
Super smart, man. When contexts are changing, go look at other places with different contexts to see where it can go and where you find your opportunity, right? Like, I think that's a really good one, man. I didn't even think about that.
Something else to add, because a lot of times folks ask this question when they're jumping on to the phones to be able to buy a turnkey property with JWB. JWB doesn't charge any real estate commissions as well. So wanted to make sure people understood that, and this is, again, kind of piggybacking off of what you and I were talking about as far as finding other ways to provide value. Every service that goes along with a typical real estate agent, helping a buyer or a seller, will provide, but we just don't charge that commission. JWB makes its money by owning the asset, selling the asset at market value, where we own it and build it or renovate it for less than market value. And so, all those services come along, and that type of mentality might be necessary for some agents. And I'm not saying you want to build JWB's business model, but think outside of the box. Think of ways that you can, maybe even earn higher than a 3% commission by providing more and more and more value. That really was the genesis of JWB's business model many years ago.
Interesting. All right. So if you want to buy a house with no commission, go to chatwithjwb.com. Just throwing it out there. GC, as we are, Lee talked this thing about, he brought up the interest rates, something where we're going next. Before we come off of this, anything else on this topic?
No, I think we hit every part of the angle, man.
Yeah, I think so. I'd love to hear from the community of this, new things that you heard or not. But yeah, I think this idea, if you're a realtor, you're worried about this, look for other contexts, look for places that you can add value, right? Like, there's going to be a bunch of value in creating educational material that can be, you can grow an audience around, that you can sell as like do-it-yourself stuff. You can think about changing your business model of where you're charging and what you're charging for, like JWB has done, and where you add it. You can think about diversifying income streams and moving into the realtor community and create into the investor community and creating these opportunities like the mailbox money that you can do with JWB, or you can focus on being the best, or you can focus on being the cheapest, right? Like, it's all gonna kind of change, and there's going to be a lot of opportunity as this happens, as well as opportunity for you to bury your head in the sand. So I think the most important thing is to really be seeking what the next step is and what the next landing point is for your business and your business model.
Did have something else to throw in there.
I love it. That's why I just talked long enough for you to think about something.
Well, good job, man. Good job. Just some interesting data points. I'm trying to understand the context, how big of a deal this is. So I think one of the best ways to really truly understand that is, how much is this costing in some of these legal settlements? So just to throw some of these settlements, these are some of the brokerages that have settled already. The National Association of Realtors has decided they've said that they're going to appeal it, but there are many brokerages that are saying, you know what, I'm going to cut my losses. I'm going to stay out of this thing. RE/MAX settled for $55 million. Coldwell Banker and Sotheby's settled for $83.5 million. So the settlements to remove themselves from the ongoing litigation is large. To put this in context, the settlement for RE/MAX was equal to 14% of the market cap for RE/MAX and their parent company. So 14% is what the settlement was. So it's a big deal. Hopefully that gives some context. And something else interesting that Dan let me know is that National Association of Realtor dues start coming due, I believe, in January. And so you're going to start to see who still wants to be a part of the National Association of Realtors. Many brokerages are not requiring that. So I think as we're starting to think about where does the story go from here, it's going to be going on for quite a while. But I think probably in Q1, we're going to even start to see more things happening. You'll probably start to see more settlements take form and take shape. And some of the ongoing questions about how business is going to be transacted, hopefully will get cleared up a little bit more as we get into 2024.
Awesome. Yeah. Big data point then coming in January, right? Like what the renewals, how the renewal rate kind of responds to all of this stuff. Very interesting. Conrad Gastoni put in the chat. So he's only chatting us, but he asked if he's interested in private lending with JWB, is there somewhere to go? I send him to chatwithjwb.com. Is that the best place to go?
That's great. And if you want something super easy, you can just send an email to info@jwbcompanies.com. You can give us a call at 904-677-6777. We'll be here to help.
All right, sweet. Just for the record, I know that there's a big audience here today, right? So I know a lot of people aren't always here, but when you normally dial into Zoom, you are defaulted to only talk to me and Greg. So unless you've changed the little box above where you chat to everyone, you're only chatting to us. So if you're asking something to the audience or trying to say something to everybody else and you want some feedback, only we're seeing it and I might miss it. So, but anyways, I got you, Conrad. Tara Paget's got a question in the Q&A. This may be off topic, but shooting my shot anyways. Go ahead and shoot, Tara. We encourage people to shoot shots around here. Who pays the title insurance in a transaction and who does the title insurance cover? I've received conflicting answers from different real estate agents around this.
You know what? I'm a few steps removed from specific answers like that, but you know who is awesome at that answer? Cassandra Knatzer, who I think is in the chat. She's on JWB's team. So KJ, can you help clear that one up? I'm a little bit, haven't looked that much into it in quite a while. So hopefully we can get that answer for you.
Yeah, there you go. KJ is Cassandra Knatzer in the chat. So Tara, look for a DM from her in the chat right now. GC, the other thing that we talked about is buying down interest rates, right? Like, should we buy down interest rates? Give us real quick a purview of like, what is a rate buy down and how to decide if it makes sense for you.
Yeah, absolutely. So many people are not aware of this, but one opportunity that you have when you buy a home or an investment property or refinance an investment property is to do what's called buying down the rate, which means that you can pay in advance. It's called paying points, but you can pay in advance a lump sum in addition to in exchange for lowering your interest rate on the loan that you have, which reduces your monthly payment. And for some folks, it can be a great opportunity.
Okay, so great opportunity for folks of buying it down. How does one think through that? Like whether one should buy it down or not, right? What are the questions to ask?
Yeah, absolutely. So it's first, just as a general kind of rule of thumb, and this rate changes with the market, but generally it costs you about 1% of the loan amount in order to drop your interest rate 0.25%. It may fluctuate a little bit, but it costs you 1%. So if your loan is $200,000, it'll cost you $2,000 to move the interest rate on that loan down 0.25 point. So it's good to know that. So now we can start to say, okay, well, how do I go about making a decision as to whether or not this is right for me? So what you do is you understand, okay, well, how much is my loan amount, right? How much would it cost me to drop the interest rate? And you can start to run some numbers. You wind up with a total cost of the points, which is the upfront payment. And then you start to model it out and you say, okay, well, how much am I going to save every single month? And then how long is it going to take for me to break even? And that's called the break-even point. If you are going to be in your home for longer than that, or be in that loan really is the key, not refinance. Longer, if you're going to be in longer than that, then it's a good decision to go ahead and buy down the rate, pay the points in advance. And it's a relatively simple equation. We can help you do that. All of our clients have access to our, JWB client service team, and our portfolio managers are on the sales and service side. So can help you do that if you need some help with that. But it's it was an even bigger topic 2 years ago, 3 years ago, as interest rates were so low. The question was, should I buy my rate down then, especially because we didn't see rates getting that low? But even today, JWB clients are buying their rates down, and it makes sense. in many situations. And then there are some situations where you could say the opposite makes sense, to not buy the rate down. You might actually make a better return on investment to do that.
Okay, I'm going to put on my noble fool hat here and ask for my friend that may or may conflate these terms with different things. I hear buying down a rate. I also hear buying down your loan. And then I also hear refinancing your loan. Can you talk to me about the difference between those three and how they interact?
Buying down your loan and buying down your rate should mean the same thing.
Okay.
So that means that you're paying money in advance. You're paying a lump sum. It might be $5,000 that you're paying to the lender as an additional closing cost in exchange for your monthly payment for that loan going way down in the future. So your loan balance doesn't change. You're just paying in advance so that you get a decrease of the interest rate. And the bet that you're making is that you're going to stay long enough in that loan that you're going to make money off of it. And the bet that the lender is making is that you're not going to stay long enough and you're going to refinance or sell your house quicker than that break-even point, at which point they would have made more money off of you.
Got it.
You want me to go into refinancing?
Yeah, continue.
Yeah, refinancing is taking an existing loan that you have and replacing that with a different loan. And you generally do that when you have better terms, because the market can bear better terms today than maybe what it could in the past when you took that loan out. And so people make that decision. That can also lower your monthly payment. It can also create a capital infusion for you. If the equity in the home has risen so much, risen very highly, as many of our investors have experienced, you can refinance. You can keep your payment the same and take money out of the house that you can use in other places. You could reduce your monthly payment and maybe not take money out of the house. You could do a combination of both. So refinancing is really that opportunity to replace an existing loan.
Got it. So let me describe these things in kind of like the layman's terms, and you tell me if I'm right here, because I'm in what you described. I think there's a gap in something that I'm asking about. There is buying down your loan, buying down your rate, which happens when you are first purchasing a property and you are applying for a mortgage. You make the calculation of, do I want to put in a certain amount up front? And that will, there's the down payment, and then there's like more money that you can put down up front that will give me a lower rate on my mortgage, right? Then
true.
There's the, how much do I put down up front? That is my down payment that will give me a lower loan balance, right?
That is true. Yes.
Those are two different things that could be called buying down something, right? So it's like like your down payment buy down your loan balance, or you can buy down your rate by giving a certain amount of money, and that percentage that you are paying in interest for the life of the loan differs.
Yes. I see where you're going. So buying down the rate would be the interest rate. Putting more money down would be the other way of talking about it. When you put more money down, your loan balance is lower, and it generally has no effect on the interest rate or a relatively small effect on the interest rate.
Got it. And then once I'm owning the property, right? I own the property now. I've already bought it. There is a situation where you can refinance your property, which means that you get a completely different loan on it that could be lower or higher. And this means that, you're essentially getting a lump sum of money based on the equity that's in the home because it's gone up over time, or you are refinancing into like a lower rate because rates have gone down, and now there's going to be a different rate because you're refinancing, and you're also receiving some money that you can use for a couple of different things that I'm going to then go into, right?
Let me take a step back. Okay. Yeah. So we can't separate this as only during the buy and only during while you're owning the home, right?
Okay.
When you're buying, you have the opportunity to buy down your rate. You have the opportunity to put more money down. Any of those happen. Later on, 3 years later, you have the opportunity to refinance, which means replacing the loan. You still then have the opportunity to buy down your rate. You still have the opportunity to put more money down, all of that. And so you generally are only going to make the decision to refinance when it serves a purpose for you. Either the interest rates today are lower than what your previous loan was, or your equity value is so much higher that it gives you the opportunity to cash out and bring some money into your pocket.
Got it. And then when you're owning, there's also a scenario where, I don't know, let's say I inherit some money. Let's say I have a huge bonus and I want to buy down my loan, where I say I have an extra $100,000. I want to pay the bank another $100,000 for like payment on my house, which means I owe less on my house going forward. Is that also something that is a different scenario that one can consider at times?
Yes, but let's not call it buying down the loan, because you're not buying anything there. You're
Okay.
just paying it back. It's an aggressive pay down structure
Okay.
is what you're talking about.
Cool.
Right. So if you're buying down the loan, you're really talking about the interest rate generally, because you're actually paying for something to get an interest rate reduction. If you're taking that bonus like you're talking about, after owning the property for 10 years and you have a $50,000 bonus that comes to you, and it makes sense for you to just pay that loan off, that would be accelerated pay down.
Accelerated pay down. Okay, cool. So that's the other thing that could be seen as buying something down. You're just basically like taking equity off, right? Like you're anyways, I'm not going to call it buying down. You're aggressively paying back your loan,
Yeah.
right?
Mhm.
So I say all that because for a couple of different things, there's many options of doing this, right? So the idea of going to chat with JWB to have somebody like talk through all these different options when you know you want to be a rental property investor, you're not sure if you have enough money or, like qualifying income or whatnot, or you just want to like do more with what you're doing. It's worth going to chat with JWB to talk through these different things and how it fits in for you, whether you already own a property, whether you're looking to buy properties for the first time, whether you are, if you're already a JWB client, you're doing this with your portfolio manager. But it's one of these reasons to go to chatwithjwb.com to talk through these different scenarios of buying down your loan, buying points on, I guess it's buying points,
Buying down your rate.
Yeah, buying down your rate, whether you have existing real estate that you can refinance to then buy properties or other places that you can do it. It's one of the reasons why people go to chatwithjwb.com and get into this conversation. And furthermore, I also want to promote the fact that we have an upcoming show with Paul Shively that is talking about advanced aggressive pay down activities, something we call C3X. I know that the community loves talking about this thing. It is a confusing thing, and we're going to have a whole show around these aggressive payoffs and how quickly that you can pay off a property, maximize cash flow, stuff like that, right? So I wanted to just clear the air there and tease a little bit of that.
That show on Thursday is going to be really something you want to tune into, because it's even better than the scenario that I just talked about. If you have $50,000 that comes in and you just pay that loan off, that's an easy way to do it. But there's actual strategies. You can take the same amount of money and position paying off something sooner rather than later. And by doing this with a strategy in mind, that same pile of money can pay it off 3 to 5 years quicker to get to your state of financial independence or your goals and whatnot. So it's how do we take the same pile of money and get better results? That's what the show on Thursday is going to be about.
Yeah. So the show is on Thursday. It's actually the show in 2 days that we're talking about that, right? I kind of said it as like in the future, we're going to have Paul Shively come in here. So that's going to be a great show of us talking through exactly what Gregg just talked about, right? So like something to consider. And then the last thing to consider is the idea that mortgage rates just came down, right? So like basically what we're saying is whatever you thought about rates and whatever your payment's going to be, it is a really, really good time to go to chatwithjwb.com to talk about the change in mortgage rates, the ability to buy down your rate, and all these other tools that you can use as a financial engineer.
Yeah.
Yeah.
I just want to talk about this specifically about rates just coming down and put this into context here. So rates, when we did our quarterly real estate market update, rates were at 6.75% for JWB clients. That was a lot lower than what you were getting in the marketplace because of our relationships and from a couple of other things that I'll share with you in just a second. But rates were 6.75%. Now rates are 6.125%. So they've dropped over half a point just in the course of, call it, the last month. that's a real advantage for you. So like if I start to combine how much it costs to buy your rate down, let me put it in terms this way, right? Let's just say that the average loan is a $200,000 loan. To drop your interest rate a half a point a month ago, it would have cost you $4,000 to drop your interest rate a half a point. That's 0.5%. Well, interest rates have just come down over the last month. And guess what? You still are able to get that incentive, which would have allowed you to drop that rate. You just don't have to spend it on dropping the rate now, right? So another way of saying this is one of the reasons that JWB has been able to keep our rates so much lower than what you get out there is because JWB has offered to buy the rate down for our clients for, I don't know, probably close to a year now. As soon as rates just got bonkers, we leaned in and we said, hey, listen, we're going to pay down as much as we can for clients so that we can buy down the rate. The max that we're allowed to pay down is 2% of the sales price. So largely the way that this would shake out is that that concession that we have made to clients, they're in turn making the decision to buy the rate down. Well, a month ago, they would have spent that $4,000 or $5,000 or what have you, and they wouldn't have seen it in their bank account, and they would have winded up with a rate of, call it 6.125 or 6.25, somewhere around there. Now, you still get that incentive from JWB. We're still offering that incentive, the same one we were offering a month ago, even though rates have come down, we're still offering it. And now you have the opportunity to decide, do you want to pocket the cash? Do you want it to reduce your out-of-pocket closing costs when you purchase the home? Or do you want to put it towards buying down the rate and get it even lower? So it's an opportunity as rates overall continue to come down. You're going to see this incentive from JWB go away because it's not something that we ever did before. And as rates have gone and risen really high over the past couple of years, it's something we stepped in to do, but it's not going to be an ongoing thing. But now you still have that opportunity. You still do get the incentive. JWB is contributing up to 2% to be able to buy the rates down for clients. But again, you have the opportunity to just keep the money and just not buy down the rate. This is something we talk about with every client when they go under contract. What's right for you? Do you want to pocket the cash? Do you want to have the rate lowered? So it's something that if you have questions about that, if it's right for you, reach out to us, talk to our team. We're going to be able to walk you through it and find the right solution for you.
Great summary, GC. That's definitely a clip we're clipping out. Michael Santoris has a quick question to close this out here. Greg, if you already have a $200,000 existing loan and knowing that you have more closing costs to refinance, wouldn't it only make sense to refinance if you can shave 1.5% from the current loan?
Would it only make sense? I'm not following the math on there. I'm not saying you're wrong. I just can't do it right off the top of my head there. But if you have a $200,000 loan and you just that was just enacted, call it in the last 6 months, it's going to be unique that it would make sense for you to refinance, right? As rates are higher today, it makes it, and rates haven't dropped all that much right now from where they were, call it a year ago or 6 months ago, it's going to make it really hard to make sense to refinance in the short run. What will happen is over time, as rates do come down, we are going to have a glut of clients, and the overall economy is going to have a glut of folks that are refinancing at some point because they had 6.5%, 7.5% mortgages out there that they'll be able to refinance. And if rates come down to 5.5%, then they will, it'll make a lot of sense for folks to do that, and it'll pay for itself very quickly. That break even will be pretty quickly. So I don't know if that answers your question, Michael. Sorry, I can't do the quick math. I'm not sure how you got to the 1.5% there, but if you want, you can go ahead and send it over, and I'll get you an even better answer next time.
Sounds like an ideal thing to follow up on, GC. I know you're really good at that stuff. I want to just let everybody know I got a lot of requests about like whether this call is being recorded, so which tells me that bunch of new folks here. Love it. Love having you here. Just so you know, we release these calls. This call will be released Monday on the JWB YouTube channel and also the JWB podcast called the Not Your Average Investor Show, which is what we're doing out here. So yes, all of this stuff is recorded. If you subscribe to the YouTube channel, subscribe to the podcast, you will get it automatically and you can rewatch this stuff. And we love having you here. This was a really, really well-attended call. Not surprised. Normally, when we have big things that happen and we talk about it, the community shows up, asks great questions, great chats going on here. And it just never goes without noticing that you take an hour out of the middle of your day on a Tuesday to spend with us and be part of this community and just feel really, really grateful for it. GC, you got anything to add?
No, I also want to say thanks for everybody for reaching out to your friends, your family. I think that there's certainly a connection between our increased viewership today, as well as you all reaching out and bringing your people to come and join the show. So I want to say a special thank you to those of you who did that. Great opportunity for us to chat it up today on a topic and a couple of topics that I think are really timely, really urgent, really important, and appreciate the opportunity to do this with you all.
We didn't get a chance to hit on the boomer conversation, which we can do on a future show on another Not Your Average Insight. We'll kind of like break that apart if we get a chance. But if you're curious about that, bring it to the Facebook group. We'd love to get in that conversation. But hope you join us on Thursday, where we're going to be talking about the rapid pay down rates and what we call the C3X. This is a topic we've talked about before, always very, very well attended because it's really, really valuable information of how you can reach your retirement and cash flow goals way faster than you imagined with this advanced mathematical formula. And as always, good friend of the show, Fortune Builders Passive Income Club. What's his title over there? He's the head of the Passive Income Club, Paul Shively.
Yep.
Good looking fella. We call him the Jason Statham of real estate. It's going to be a lot of fun. And more importantly than just a good looking fella, he has our sense of humor. It'll be full of self-deprecating and making fun of each other. But up until then, we advise you to come. And we have one other piece of advice, GC. What is it?
Don't
be
average.
Average. See y'all on Thursday.
See you.